Alright folks, so today we're going to talk about the next chapter, chapter 2 of the textbook, and what they start out with is they start out by discussing the expanded tax formula. And in that same section of the chapter, they talk about the two other 1040 variations, the 1040 and the 1040A. They have a chart in the book that shows you which items show up on the 1040 and which ones show up on the 1040A, and you can kind of see and compare that obviously the 1040 has the most level of detail for an individual, and the 1040A is kind of the middle ground between the 1040EZ and the 1040. So the 1040A has more detail than the 1040EZ, and there's much more you can do with it than the EZ, but the highest level of detail is the 1040. And the expanded tax formula pretty much follows the format of the 1040. So if you look at the 1040, and you can look at the one in your book, you can also Google the 1040 form. Just make sure that the link you're clicking on is irs.gov. Make sure that's in the address that you're about to click on to see the 1040. If you see that, it should be good, and that'll give you a PDF copy of the 1040. Otherwise, you could look at the one in your book that they have on a few pages there. So the top part is what we call the gross income. The formula starts with just income, and then you subtract anything that is excluded. And that gives you your gross income. So the gross income is actually what appears in the middle part of the 1040. You can actually see it begins on line 7. That's where it starts. And the first thing that it asks for on line 7, I believe, is your wages, like from an employee, or like being an employee and collecting wages. That's the first thing that it asks for in the gross income section. Now, what is an exclusion? So basically, an exclusion is something that's not taxed. An example of that would be if you sell your primary residence, like if you own a home and you meet the requirements of that being your primary residence for several years, you can sell your house, and then a certain amount of what you make, the money you make, the profit or gain on selling the home, if you sell it for more than what you bought it for, then that'll be excluded from your income. You won't be taxed on that, at least at the federal level. So that's what they're talking about there. So, but remember, the 1040 begins with the gross income section. Okay, next, after gross income, we have these 4 AGI deductions. Okay, and then when you subtract these 4 AGI deductions, you get your adjusted gross income. So this is a very important landmark. It's the bottom of page 1, and it's also the top of page 2 of the 1040. Adjusted gross income. They use this number, adjusted gross income, to determine a lot of ceilings and floors. So that's kind of like the importance, the bearing that it has on the return, is it determines ceilings and floors. Example of that is if we talk about charity. Historically, charities, the money you give to charities, churches, other religious institutions, educational institutions like universities. So if you contribute money to those types of institutions, entities, you get to take a deduction for those, but you're limited to a ceiling, historically a ceiling of 50% of AGI. So that's what it has been historically. With the new reform, they've actually upped that to 60%. So you can just memorize the 50%, but just know that starting in 2018, you can deduct up to 60% of AGI. So that's a ceiling. An example of a floor. So just an example of that. If I have AGI, or adjusted gross income, of 100,000, I'd multiply that by 50% in 2017, and I can deduct up to 50,000 of that charity. Or yeah, I meant to put 50K for 50,000. Now, an example of a floor would be, I think I'll start a new page here. An example of a floor would be like for medical. So a lot of people think, oh, I can deduct my medical expenses, so I'm going to bring a bunch of medical receipts to my accountant to have them add them up, and then I'll get to take a deduction, get a tax benefit, and save some money on tax. Well, that's not normally the case, because for the past few years, they've had this floor of 10% of your adjusted gross income. So for instance, if I make $100,000 a year, if that's my adjusted gross income, they basically take that number, they multiply it by 10%, and then we get a floor of $10,000. What that means is that the first $10,000 I spend on medical stuff doesn't count. So it's only every single dollar that I spend in excess of $10,000. So if I spend $10,001, then that $1 over $10,000 I'll get to deduct and save some money on it. And then if I have $20,000 in medical expenses, then okay, yeah, the first $10,000 doesn't count. The second $10,000 of that 20 would give me a tax benefit, and I'd save some money. But I mean, it's very, very hard to get over this 10% threshold. They've changed it to starting in 2018. So before 2018, it was 10% for a while. And now with the new tax reform, they've lowered it to 7.5%. That's still a high threshold to get over. Yeah, if you just try it, multiply it out. And it's only out-of-pocket stuff that you can count towards this. You can't count anything that's covered by insurance. So it's still, I mean, with insurance coverage and everything, it's a hard floor to beat. But 7.5%, that floor has been around for a long time. But what happened is during the Obama administration, when they came out with the Affordable Care Act, they upped it to 10%. Now it's going back down to 7.5%, like it was before for many decades. Let's go back to the previous page. Let's continue on with the formula. So I explained to you this milestone on the form. That's for a 2-page 1040. It's the bottom of the first page, top of the second page. So there are certain deductions that you can take that are called above-the-line deductions. Those are the 4 adjusted gross income deductions. That means they're above the line or above adjusted gross income. And they're normally more favorable because you don't have to worry about the standard being higher or lower than how much you have in itemized deductions. So we'll talk more about those later. Then we have from adjusted gross income deductions that we get to deduct. And that actually gives us our taxable income. Right? So what's in this number, the from AGI stuff? Well, if you don't itemize, so you heard me say that word a few minutes ago, if you don't itemize, historically you've basically had two things that you can deduct. You can deduct the standard deduction. And I'm going to abbreviate that. Oh, I better not write that. It looks like STD. Let me erase that. Let me just write out standard deduction. And how much is that? Well, it depends on your filing status. And it changes every year with an uptick in inflation, and it's changed dramatically with this recent tax reform. So we never normally, teachers of tax classes, they never normally make you memorize standard deduction amounts. So it depends on your filing status. You will be given information like a chart or to reference to figure out what a standard deduction would be for a particular filing status in a particular tax year. You'll be given that information so you don't have to worry about memorizing these numbers that change every year. And then historically we've had these personal exemptions. So those are the major those are the major from AGI deductions. Okay, so that means that we deduct them from the adjusted gross income that we just calculated, and then that gives us our taxable income. So exemptions are normally about $4,000 per person reported on the return. So if you were by yourself, you'll get about a $4,000 exemption that reduces the amount of your income that gets taxed. And then a standard deduction for a single person would be around $6,000. So in total you'd have, without even, just for living and breathing and making money, you have automatic deductions of about 10 grand if you include both the standard and the exemptions. Now, one thing that's changed with the new reform is that exemptions have not gone away. They're no longer an issue. So doing your 2017 returns, you'll still see them. But starting next year, and unless the tax policy changes and some administration, they no longer exist. We still look at dependent rules in order to be able to claim those, but in general, just know that they're gone. Now, do we still need to know dependency rules? Like, if we're going to claim a child or claim somebody, we'll talk about that later in this chapter. Do we still need to know those? Yes, we still need to know those most likely because they'll use those to calculate certain tax credits that benefit you. Yeah, so you still need to know dependency rules, which we'll talk about in a little bit, for claiming certain tax credits. Okay, so that's an overall way your taxable income is calculated. The taxable income, you apply tax rates to it, and that will give you your tax. And then from that, you'll deduct payments and credits. So we subtract that out. And that will give you your tax due or a refund that's due to you. So tax due means it's a positive number, so we need to write the IRS a check now. And if it comes out as a negative number, and since in essence the payments and credits are more than the actual tax that was calculated, then you get a refund. You get a negative or / refund back. Alright, well I hope that was informative. We'll go through this formula again several times over the course of the semester. Probably look at it again later in this chapter. But I'm going to go ahead and leave you with this, and I hope you are doing well. 15 minutes?